Picture this, you are an investor and your portfolio is soaring high. You feel like the Wolf of Wall Street, ready to celebrate your genius.
I have been a rich man and I have been a poor man, and I choose rich every fucking time.
But wait, the market nosedives and suddenly you are more like the Chihuahua of Cheap Street, shaking as you will go from hero to zero. Ever felt this way? Ever wondered why most individual investors have lower returns than the pros? This first and most important thing to know is this. Studies show that the average individual investor earns about 2 to 3% less per year compared to professional investors because of emotional decision making and market timing errors. But it doesn't have to be this way. You are about to uncover the best kept secrets in the investment industry. Mastering your emotions is the key to unlocking millions in your portfolio. For example, investing $2,000 per year in the S&P 500 over a period of 40 years with a 10% return could net you $1 million. Panic and pull out during downturns could cost you millions. In this video, we will reveal the best strategies to stay steady no matter what happens. Because let's be real, the market will have its ups and downs over those 40 years, right? So the most important thing is to learn how to ride out the storms and keep your investments on track. That's why you need to understand this crucial point, and that is the emotional roller coaster. Because there's a reason why this happens to so many investors. When the markets are up, we are all too eager to jump on the bandwagon and buy high. But as soon as things start looking shaky, we are ready to bail faster than a rat of a sinking ship. Buy high, sell low. It's the anthem of the emotional investor. As our inner voices battle it out, the absurd dialogue in your heads goes something like this. Quick, quick, quick! Sell everything before we lose it all! But wait, didn't we buy that stock last week on an all-time high? Who cares? The sky is falling. We need to get out now! It's like watching a tennis match between two players who have never held a racket before. And let's be real, we all have been there. We have all felt the rush of adrenaline when our investments are soaring and the gut-wrenching panic when the market takes a nosedive. Even a seasoned investor feels the stress during turbulent times. Like Jack Bogle, for example, the founder of Vanguard Group and a pioneer of index investing.
But never be out and think you can get back in, because your emotions will defeat you totally.
With decades of experiences, Bogle reminds us that the market declines are not just probable, they are practically inevitable. In his words, the market will probably go down 50% every 25 years. So how do we keep our head cool when the market's playing jump rope with our emotions? But here is the kicker, the market rises 75% of the time. The longer you stay invested, the smaller the chance of a negative return becomes. So even though it might feel like the end of the world when your portfolio is in the red, history shows us that the patience pays off. In the wise words of Jack Bogle, these basic principles are so idiotically simple. But simple doesn't mean easy, especially when your emotions are running the show. And that's why you cannot miss the next one. And that is the psychology of market downturns. So you are caught in the eye of the market storm, watching your portfolio plummet like a skydiver without a parachute. It's like as the market takes a nosedive, your heart races faster than a cheetah on an espresso bench. You are sweating bullets, wondering if you should hit that big red sell button and run for the hills. But wait, before you make any rash decisions, let's take a step back and look at the bigger picture. So history has shown time and time again that market downturns are as common. In fact, Jack Bogle himself noted that a 50% market decline happens about once every 25 years.
The bad years, the crisis years, the Dow dropped by about 50%, and since then it's, and people panicked and got out, of course, even in the mutual fund business, and particularly in the ETF business, a lot of net liquidations at the lows, and now we're back. I think the gain from that level is maybe 200%. So it shows you that when you act on the emotions of the marketplace, you're making a big mistake. I stay, and always have said, stay the course. Don't let these changes in the market, even a big one, that was a 50% decline, don't let that change your mind.
And here's the thing, panicking and pulling out of the market during a downturn is like jumping out of a plane just before takeoff. You don't want to miss the opportunity to reach new heights. So take a look on some of the most infamous market crashes in history: the dot-com bubble burst, the financial crisis in 2008, and the COVID 2019 pandemic panic. Despite these downturns, the markets always bounced back when least expected, like a rubber ball on a trampoline. So instead of letting your emotions run the show during a market downturn, it's time to channel your inner sandmaster, take a deep breath, do some yoga poses, and remember that patience is a virtue. Easier said than done, right? Well, be ready because we are going to dive into some strategies that can help you stay calm. It's like having a mini Warren Buffett on your shoulder, keeping you on track. And let's remember the past. Trying to time the market is like trying to catch a shadow. It doesn't work well. Over the last 40 years, the market has ended up positive with 75% of the time. That's like flipping a coin and getting heads 3 times out of 4. Remember, the best days for trading usually come right after the market has dropped. If you pull out during tough times, you might miss out on big gains. It's like leaving the party just before they serve the cake. So how do you stay calm when the market's acting up? Diversify your portfolio like you are building a balanced meal. Set clear investment goals and stick to them consistently. And please avoid checking your investments every 5 minutes. It's as pointless as watching grass grow. Now let's dive into the final part, but the most important one: becoming an emotionally intelligent investor. So you have weathered the storm and come out on the other side a little wiser and a lot more resilient. Becoming an emotionally intelligent investor is like earning a black belt in the art of financial zen. It's about embracing the ups and the downs of the market with the calmness of a monk meditating on a mountaintop. So do you still remember the inner voices we talked about earlier? Well, now it's time to give them a pep talk. Instead of letting them run wild with fear and panic, train them to sing a different tune. Remind yourself that short-term volatility is like a blip on the radar of long-term success. Think of investing like planting a tree. You don't expect it to grow to the sky overnight, right? It takes time, patience, and a whole lot of nurturing. The same goes for your portfolio. Give it the love and attention it deserves and watch it blossom over the years. But why stop here if you want to take your investing knowledge to the next level? You cannot miss out on our next video, should you buy or wait for a market crash to buy stocks. We dive deep into market downturns, revealing the real truth about the data and what you can expect. So don't miss out on this essential guide if you are a serious investor.